Now, Inghams is one. It is our stock of the day, falling down the pecking order today after reporting unprecedented challenges due to the surge in Omicron. The company is saying all of its sites were experiencing significantly lower levels of staffing availability, which was impacting operations and performance of the group. However, it does expect its production capacity to recover quickly to meet demand and is implementing initiatives to minimise the impacts of COVID. The market not taking kindly to that update, shares off more than 7% at the moment. So what do our experts think? Howard, Inghams chicken, winner chicken dinner? Maybe not in this case.
Oh, well, we can enjoy their products, but it doesn't mean we have to own their shares. Looking at the company itself as opposed to the products that they produce, the debt to equity ratio is enormous, way beyond anything that would pass our filters. And their return on equity is incredibly high, which is normally something we would like. But if you look at those two things together, what it really says is they've got very little equity on their balance sheet, an enormous amount of debt and very little equity. So it's not a company that any of our Teaminvest members would give more than a glance to. They'd see that debt to equity figure, the debt to market cap figure, and they would shudder and say, too much risk, we'd rather be invested somewhere else. After all, you really only want about 20 companies, maybe 25 in your portfolio. You can afford to be fussy.
All right. Scott, do you want more chicken on the menu?
I remember the old ads, and it used to be Inghams chicken, love them, and that sticks in my head. It's a tough one. Right now, Howard is exactly right. This is a moderately growing business with a whole lot of debt. Look, yeah, staples businesses can tend to carry more debt than non-staples businesses, and there are two ways to look at this. The first, as Howard says, is this one of your best, 15, 20, 25 ideas? The other is it likely to beat the market? So, is it a buy from that perspective? After all, your companies that are beating the market, that's in theory, otherwise you buy the index, right? So that's the other way to look at it. I think the challenge with Inghams is twofold. The fall today seems to be completely overdone. If you believe management, and we can choose to believe them or not believe them, then this is COVID related specifically. Now, I remember, you have to tell me, Jeremy Siegel it was, on CNBC in the US, who said at the beginning of the pandemic, if every company's earnings in the US fell to zero for 12 months and then went back to normal in the year after that, shares should fall no more than 10%. The discounted cash flow, if you work it forward, that was his estimate of what they should have fallen. Now, if you look at Inghams and say, well, hang on, shares are down 7.5%-ish, is that a permanent destruction of value, or is the COVID blip, as management says, a temporary problem they're going to fix? If it is, and you liked the company yesterday, you should like it even more today because you're being given a discount. You're getting a chance to buy it for 7.5% less than it cost yesterday, when the future, other than maybe the next couple of months, should be, if management's right, as good as it ever was. And so there's a really different way of thinking about these things. I do agree with Howard more broadly, though. It's not one of the better businesses on the ASX in my mind, simply because it doesn't have the growth potential, it doesn't have the economies of scale or the returns on capital or investment or equity that you would want necessarily to make it one of the top echelon businesses. So look, if you wanted a business like this in your portfolio, you wanted some more stability, you wanted a bit of cash flow that wasn't related to just a bank or something else, I can imagine people jumping for it. The other part, unfortunately, if you look at the financials, is they've been all over the place in a good way recently. But the problem is on balance, it looks like a PE of 6 times earnings, if you believe, or not if you believe, if you use the most recently reported numbers. The problem is they were more than double the previous year. So it's something closer to 12 or 15 times earnings based on the previous year's earnings. And like all companies, you should look forward rather than backwards and say, what does the future look like? Nowhere near enough certainty, nowhere near enough growth for me to take that risk. So I wouldn't buy it either.
Okay, so that's pretty much an avoid then from both. That is Inghams.